What's up guys, it's Matt, and I'm back with another tutorial video, and this one is going to be part 4 of where I teach you how to use and understand candlestick charts as a technical trader. So if you haven't checked out the previous parts, I will link them down in the description, and if you find this video helpful and you'd like to see more content like this in the future, be sure to drop a like and subscribe to this channel. So when it comes to candlesticks, as I've explained in previous videos, you can either have a bullish candle or a bearish candle, but the size of the candle in relation to the other candles around it is also important. And that's because the size of a candle can help give us a potential clue as to how much buyer pressure or how much seller pressure there is in the market. So in this example, we have 3 bullish candles, and despite all of them being technically classified as a bullish candle, we can agree that they're all different in size. So if we imagine all of these candles on a chart, and the bottom of these candles is priced at $100 and the top of candle C is priced at $105, this means that more liquidity was needed from the side of the buyers in order to push candle C from $100 all the way up to $105, and more liquidity was needed compared to candle A and candle B that might have only pushed up from $100 to $101, or in candle B's case, it might have only went up to $103. And what this shows is that there's much more buyer pressure behind candle C compared to candle B and compared to candle A. And that's because it takes a lot of money to move the markets. And so if you want to move the markets from $100 to $105, you need much more liquidity compared to moving the markets from $100 to $101. Now, this is not something that the average retail trader can do, so you'll need millions or billions of dollars depending on the asset or the market, but this is what's needed from the institutions in order to move the market so much. And usually what this also correlates with, but not always, is that typically if you have a larger candle that required more liquidity in order for it to move so much in its price, what you'll have is you'll usually have an increase in the volume. But the context will matter depending on the asset that you're trading or the market and the market conditions. And that's because if you're analyzing 2 different charts of 2 separate assets, and one of them on average has more volume, more volatility, and more liquidity, well then the average candle will be much larger in size compared to the second asset that might be the opposite, where it has less volume, less liquidity, and less volatility. Now in this example, I only drew 2 or 3 different candles, but ideally, if you're analyzing the average market conditions for a chart, you shouldn't just look back at the most recent candles, but instead you should look back at least hundreds of different candles. And that's because the current market conditions could be temporarily different depending on any recent fundamental news events. And so after this, they might return back and regress to the average market conditions. So keep this in mind, and this is why the context truly does matter of whatever you're analyzing. And so now in the second example, we have 4 different candles that are technically all the same in length, meaning that the highs and the lows are identical, except we can see that there's a difference between the size of the wicks compared to the size of the bodies. And so if you recall, when it comes to candlesticks, they all open and close within a certain period of time. So let's say that we're looking at the daily time frame. And so how a candle closes within a certain period of time can potentially give us a clue as to how much buyer pressure there was compared to the seller pressure. And so if we compare all 4 of these candles, so candle A, B, C, and D, if we start off with candle A, we can see that it has the tiniest body but the largest wick when it comes to its overall size. And so what this means is that despite this candle opening at this price and a lot of buyer pressure coming in and pushing the price up to this high, the buyers were not able to hold on to this, and that's where the seller pressure came in, and it pushed the price down from this high all the way down to this closing price, where this candle at the end of this time period, so at the end of this day, decided to close down here. And so now if we look at candle D, we can see that it's the same in length compared to candle A, except the difference here is that it has no wick and it has the largest body, which means that the buyer pressure, when it came in, it pushed the price all the way from this low up to this high, and they were able to hold on to this strength by the time this candle decided to close, which was at the end of the day. Now, this doesn't mean that there is no seller pressure at one point during this period of time. So obviously, if we wanted more detail, we would simply drop down to a lower time frame where it might show us that the sellers came in and in this example might have pushed the price back down, but they were not able to hold on to this seller pressure, and that's where the buyer pressure came back in and it closed the candle near the high. So in this case, the buyer pressure was able to overpower the seller pressure. And to finish off with candles B and C, which are pretty similar, what this means is that the buyer pressure initially came in and it pushed the price up to these highs, but it was not able to hold on to these prices by the time this candle closed. And so that's where the seller pressure came in and it pushed the price back down to where it closed with these upper wicks. So if you enjoyed this video, then be sure to drop a like and let me know if you would like a part 5. And also be sure to join my trading community. The links to the Telegram app and the Discord app are provided in the description. Thanks for watching. I'll see you guys in the next one.